Welcome to the Expect Success podcast, where we highlight real estate as an investment and speak to the professionals who make it happen every day. Today, we are going to focus on something a little different. Anyone that has invested in real estate is going to or thinking about it again in the future. They know the importance of due diligence. And that can be on the asset itself, but it can include other things such as entering into a partnership. So today I'm speaking with Shane Pogue, and he is a professional who helps people do exactly that with real estate as well as other things as well. But I'm going to turn it over to Shane so he can introduce himself.
Absolutely. It is a very, very important part, especially in real estate investment. But basically, anytime you're out in the private equity space, you're giving money to people. It's not as heavily regulated. So you need to be very careful about where you're placing your money. But what I do is actually a special subset of due diligence known as investigative due diligence. And this mostly focuses on your actual partners and their businesses and kind of their interactions there, as well as verifying their track record to make sure that if you're working with, say, a syndicator and they have this huge, enormous track record and they're saying all these great things, we're just going to verify that. And sometimes we verify it and nothing comes back, but it's important to check because every time you don't check, you run the risk of something bad happening. We know there's a lot of bad actors in the space, and we're actually out there to detect them. The subset of due diligence, investigative due diligence, isn't anything really new. I actually brought a tool that institutional investors use down to the individual investor level. And that's all I really did there.
Okay, let's speak on that a little bit too. Let's get into your background, how you got into this and how you transitioned into the space that you're in now, if you don't mind.
Oh, absolutely. So my backstory is going to be a little bit crazy. So I was never planning on going in the finance world. I've never really cared that much about money. You're probably going to laugh at that because I'm in the private equity world now. I own my own business, but I never really cared about money. I went to college with a criminal justice degree, graduated with a degree in criminal justice and a certificate in criminalistics. All that means is if you speak forensic science to me, I'm not going to get confused because I took all the classes with the CSI guys and learned all this terminology and stuff, but I never pursued it as like an actual career. So I was going into the pipelines for a bunch of police departments here in Texas, and it was kind of hard to get in. There was a couple hiring freezes in several cities around the time I was applying. They never tell you that about in college, but you always have to be very careful when you come out of college because sometimes you come out at a really bad time. And I did. Basically, my only option was to go to Dallas PD. I was going through their pipeline when I got a really interesting offer. At the time I was actually working at Walmart right out of college just to pay bills. So I was like, hey, I'm doing what I'm supposed to. I'm moving. Let's get a job to pay the bills. I've never been one that's really like, oh, I'm not going to do what I need to make sure I have what I need. I'm a hard worker, so I always do what I need to. And I actually started talking to an Army recruiter, and he was really excited when I told him about my degree because he was like, we have a pilot program in the Army net right now that you can be a CID agent if you have a college degree. So, of course, a CID agent, if you don't know, is a criminal investigation division agent in the Army, which is really, really cool to be able to get that job out of college. You do have to pass a lot of tests. There was a lot of oversight and stuff like that, but just that opportunity was absolutely crazy. So of course I started pursuing that, went into basic training, got really sick. No one knew why. After I think the second time I just passed out while we were in formation, they took me to the hospital and the doctors were just like, hey, you have a heart condition. It's probably never caused you problems in your life because it only really affects people when they're incredibly stressed, like when you're in basic training. And of course, that led to me being discharged. Well, after that, my whole life plans got thrown out of whack because I had to go from, hey, I definitely either want to do these very high stress jobs or nothing to I need to find a way to use the skills that I've learned and my talents outside of that. One of the first ways I actually did that was being a private investigator. I did that for about a year before COVID hit. And of course, during COVID, no one needed a PI for anything. No one wanted someone to go around investigating people. So what was actually happening is they were laying off their employees and trying to get them to get them on the federal funding. They were really nice guys there. I absolutely loved working there, but they were trying to basically help out their people. They're like, hey, we can't afford to pay everyone, so we're going to keep these people on, and then in 2 months when all this calms down, we're going to rehire everyone. It didn't turn out that way, but I did end up getting a call back from them in 5 months asking if I wanted my position back. But about 2 weeks after that happened, I actually got a really interesting offer from Fidelity Investments, and I joined their background investigation team first, and then moved on to their due diligence team later on. And that's actually how I kind of got in the finance world.
Okay, awesome. I just wanted to establish your credibility because obviously you have a lot that I don't want that to be lingering in the background. That should be forefront of people's minds. We deal with professionals that have built up credibility and it should be recognized. Now, clearly rolls right into the next thing. You have a strong background in risk management investigation services. That's been highlighted. Now, how does that translate into real estate? How can people who invest in real estate benefit from that, from your due diligence? And that could be through evaluating potential properties, tenants, and also partners even.
So, one important thing I want to know is that a due diligence investigation, you should never use that on tenants. It's way overkill. Essentially, the things we look at are things that aren't going to bother you if they're a tenant. We're basically looking at very, very high stakes type stuff. We're looking at a whole bunch of different information, criminal judgments, civil judgments, all these kind of things that if you did it on a tenant, you'd be doing completely overkill. But your business partners and investments, that is a big part. One of the really, really sad things about the private equity space is there are a lot of fraudsters out there, and it's very hard to detect what they do, even for trained people. So if you go out there and you say, hey, this guy is a friend of a friend, I'm just going to invest with them, see how it goes. If you can afford to lose that money, okay. But if you're making a 50K investment on this guy and you've done no checks and you lose that whole investment, what are you going to do? If was an actual fraudster, most likely he's going to get convicted at some point in court, which means you might see the money back in several years, maybe 10 years or so. But how do you start detecting that before it becomes a problem? And that's exactly where investigative due diligence comes in. We look at a whole bunch of different data. We will go verify things down to the property record level sometimes to, for example, if you're working with in real estate and you want to verify that someone did return a certain IRR to their people, well, we would actually go down to the property record level and see if what they actually sold it for versus what they bought it for. Because if they bought it for, and we have seen this before, people bought something for more than they sold it for, and then they still claim that, hey, we returned this much to our investors. I'm like, well, how did you do that? Maybe you did really, really great on rent rolls or something like that, but your whole business model is built off of value add play. So where did this money come from? And it just gives you better questions to ask, even if you want to go forward with the relationship. So maybe you go forward with her, you decide, hey, you found all this stuff. You found a bunch of civil judgments. You found some operational issues. You found a couple of civil lawsuits that needed to be addressed. But I went and asked the syndicator about this, and he answered them how I would like him to answer it. So you go forward with the relationship. Well, one of the big benefits of that is once I do a report on someone, once I start investigating them, I keep them in our records and we actually have an active monitoring program. So as new stuff happens, we actually can go and say, hey, we're seeing this new issue. And this is really, really beneficial to people that are proactive in investigative due diligence because sometimes they will be like, hey, I haven't invested with these guys. I don't plan investing with them in the near future. And then they have us do the investigation in a couple of months later, we get something that would have just tanked the whole deal. And they're like, hey, we didn't actually invest with them yet. So now they've solved the problem right off the bat. And this has happened several times. There was one where the company we investigated sued the SEC. And that's always a big red flag. You never want a company you're working with to sue the SEC. Of course, there's always the kind of like, hey, is the government being over regulatory? But at the end of the day, usually people don't like to poke the bear. Even big companies don't like to poke the bear. So it was a very out there situation. And there was a whole bunch else involved in it that came out down the line. But the good thing was because they were proactive, they never invested money with them. They saw that SEC lawsuit, said, "Now that's a game. That's a killer to me. I'm not going to work with that." Just because it was so outside of the wheelhouse.
Okay, that actually was going to be the next question. If you have any real world examples of how your investigation either brought something to light or later on an investor didn't take your advice and still entered a partnership. Do you have one other example where you can give us some specifics, not obviously not names or details, but something that
Oh, okay.
highlights the real significance of the due diligence process and how you can get burned?
Oh yeah. So I don't have any situations where someone's actually gotten burned after I gave them advice. Usually the people that come to me, they're fairly conscious about risk. I have had people invest in deals I said were high risk, but they basically went through with me, and we kind of created a risk mitigation strategy and say, hey, if we do this, if they sit here and they agree to these terms, basically it doesn't matter what they're doing on their end. You could take control of the property if you wanted to. You could do this if you wanted to. So there are risk mitigation strategies. It doesn't mean if it's high risk, don't invest in it. It means you need to have some strong strategies to combat that risk. In one situation, we were working on, it's not directly related to real estate, but a lot of real estate people love it, assisted living. So we were working on more of
Absolutely.
an institutional level assisted living facility investment. Forget which state it was in, but, and I probably shouldn't say what state it was in at that, because they're fairly large. But what we ended up seeing is our clients had invested with you guys several times, never knew what investigative due diligence is, never have done something like this before. We started looking into this person's background. There were basically everyone that you could possibly owe money to was coming after them. Investors, lenders, clients, potential investors, just everyone was suing these people. It ended up where they had over $2 million in judgments in a single county against them. And this
Yes.
person was trying to raise $5 million for a completely new investment. They had other operational issues. Of course, clients were suing them for different things. It's assisted living, so you have to be very, very careful there. When you're in assisted living, treat them like they're your family. That's the only way I can say it, because
Absolutely.
these people, they're in the end of life care. You want to make sure that they're taken care of properly. And I work with a lot of great people in assisted living facilities. So to me, it's kind of gotten to the point where I'm like, I know you can do this right. And I know it's not an investment killer to do it right. You're just being greedy at that point. But we looked into this person, and all this stuff started popping up. They had no idea before. They worked with them in the past. And it was just one of those situations where when we laid everything out, they were like, we're not comfortable even moving forward with this at all. One of the biggest things is they had helped them raise money for opening a facility in another state. And this was touted as like a really big project. They were like, this is going to change the game for us. We're going to make so much money off this. All this stuff is going to happen. And the property that they bought for that new facility was in foreclosure when we were running through our investigation. So we looked through and it's like, okay, so they're saying they're making money off this, but the property's in foreclosure. What's happening here? If the property's in foreclosure, they can't have that many tenants, right? So that brings to light some operational issues there. So why do they keep telling people that this is going well if nothing's going right for them? That's one of the big situations where you're just like, when you lay out everything, usually if it's something that extreme, someone's going to be like, no, I don't want to invest with that just because it's too much of a headache. If we were to go the risk mitigation route, and let's say my client became part owners of the whole business and were ingrained in the operations, they're still working with that guy that has all the judgments against him. They could be held liable for some of it if he starts doing stuff down the road. So it's just a huge mess that they didn't want to get involved in.
Okay. So that's a really good example because there are many different ways you can invest in real estate, and there are a lot of different ways you need to cover your butt depending on what avenue you go down. Now, for an investor that wants to deal in real estate in any aspect, what are some red flags that we can identify on our own to say, okay, we need a professional to help dive a little deeper?
Well, you would be surprised how many times I actually find people that have been convicted of securities fraud actively raising money. So, one of the very, very easy ways to check that, and everyone can do this as a free resource. It's called Sally through the SEC, SALI. If you look that up in Google, it'll pop up the search. And if anyone's ever had any individual action taken against them by the SEC, they will pop up in that search when you search their name.
Hmm.
Of course, the only issue I can see with this is some of these fraudsters are a little bit smart about it. They usually change their names at some point. That might take a little bit of harder investigation, but you might be able to find it on your own. If you can find the name change, then you'll find them in there. The SEC doesn't usually update these records, so it's going to be like a point in time type of thing. So unless they do something under the new name, then you'll be able to catch that, but you have to be a little bit careful. Don't take it as like a catch-all fix. Oh, these guys have never been convicted of fraud, so I can do business with them. There are a lot of stuff that are under the surface, and fraud sometimes is a very gradual process. We've seen it roll out over a course of 20 years before.
Oh my goodness.
So it's not something that just happens overnight sometimes. Sometimes it's just like a really, really long process. Most of them, they stick right around between 5 to 7 years, though.
Okay. Okay. So when someone is getting into multifamily and investing in real estate, they're usually dealing with a lot of syndications and property management, things of that nature. How can your help services help verify that these companies and individuals are financially sound and legally solid? You did go over a lot, obviously. Just want you to go a little deeper as far as the financial side, that someone is not as they project themselves to be.
So the main way we detect financial issues is, of course, the big ones, bankruptcies. Every bankruptcy is recorded in federal court. So if you have a bankruptcy or your business has a bankruptcy, we'd be able to detect that. Sometimes the owner of the business is not listed on the actual bankruptcy, so you have to identify the businesses under their name and then go forward from there. That's actually a long process sometimes. There's, of course, these states where you don't have to register basically your name publicly to register your business there. It does make it a little bit harder. Eventually, we usually do pull out the information we need, mainly through like naming conventions. But yeah, so we will go through bankruptcies, judgments, liens, anything like that, even things that are often considered operational issues like mechanics liens. We'll combine that all together to kind of create a picture of what's happening. Because what we typically see is when someone's under financial distress, our property's under financial distress, we see a lot of little cuts. So it's not one big one where they're just like, oh, suddenly I've lost $1 million. They're losing money consistently. So they miss their taxes 1 year. They get mechanics liens filed against them. They maybe get a judgment filed in civil court, and then suddenly you have all these little things that haven't been paid. And you can usually see what, wow, I've never not been able to see when these issues have been paid. So if you have a lien or a judgment issued against you, usually there's going to be some kind of document that says when it's been paid. If they haven't been paid over time, you start to see things that kind of morph into huger financial issues. And these can be on both businesses and the individual. So if you see someone not paying their taxes consistently, they have judgments issued against them by previous investors, lenders, whatever. You can start to build a financial picture on this person based on just really judgments, liens, and bankruptcies. We do look for other types of things. For example, I told you we dive down into the property records, see if there's anything there. We are actually not huge on the financial due diligence side. We mostly stick to those big categories though. So we don't go into like we don't go like and audit their books, because that we do what's called a discrete investigation. So we would need to actually notify them, get their books, and of course if they're actually committing fraud, it's likely that their books aren't going to be accurate in the first place. We do work with services that do that though. We have one that's called Verified Metrics, and they are very, very good at that. They mostly work in the venture capital space though, basically preventing all those different situations you see in the news these days of these people like, hey, I've got all this money and I've got all these clients, and there's no actual money to back it, and they have like $10,000. I think one of them had like $10,000 in revenue for an entire year and raised over 50 million or something like that. And it's just like, this is verifiable information, and venture capital can afford to. Most venture capital firms can afford to go overboard with due diligence if they really want to.
Okay, and that was actually a great answer, because you mentioned before about how fraud isn't an immediate thing, usually isn't an immediate thing, and it's spread out over time. And I didn't have a clear picture of how that would be until you explained that. So that makes a lot of sense. And that does go nicely with the, like you said, the institutional investigation that you do. So that actually helps out a lot. I did want to ask you too, obviously, one of the biggest fears for investors is lawsuits. And whether that be from partners, tenants, contractors, whatever the case may be, give us some insight into how your investigations help mitigate those risks before they even arise.
So, mitigating before they arise, one of the big things you're going to want to look out for is early operational issues. Mechanics liens come from, and I'm going to say this with a little bit of a note on it, because this is not always the case. Sometimes people just don't want to pay their bills, but usually they come from an actual dispute with the work. So if you get a lawsuit filed against you, or a mechanics lien filed against you, what I'm actually going to look for is the lawsuit tied to it. Here's why.
Okay.
If you have a legitimate dispute with someone that's done work on your property, we want to see what that dispute was. So let's say, and this is a real example I've had before, they completely redid the flooring on a property. Within 3 months, the entire thing was peeling up. I was able to tie that mechanics lien back to that lawsuit and say, hey, there's actually a legitimate dispute here. So it lowers the overall risk. How you detect the different operational issues beforehand, usually that's going to come with an actual audit of yourself. So this is not necessarily something that I'm solely going to do. I do work with investors sometimes to audit themselves and make sure that we're not finding anything on the back end that would indicate that they might be having issues, especially if they use a lot of third-party management. That's where we're going to see a lot of that. It's just because it creates that kind of barrier between you and the actual control of the property. And you never know who you're working with until you do the proper checks to verify them. And that's where kind of vendor risk come in, and you make sure that not just the business partners you're working with, but the day-to-day operations people that you work with, the people that you hire as contractors, the people that you maybe just have running your payroll, which is a silly use of it, but it does help sometimes. And make sure that all that is going well, because at some point, if you don't check all these boxes, you're going to start to have operational issues. And one of the ways I've actually seen that actively happen is actually with mechanics liens that all had real legitimate basis. Basically, this property manager was working with a client, and how they were saving money for the client was not paying the bills on time and basically trying to dispute them down over and over again, um, in a very informal process. And a lot of the people that did work on the property just didn't want to deal with it. So they just filed the mechanics lien, say, you better pay the property. And one of these actually almost foreclosed on the property. And luckily we caught it when we did, because it was filed, and we'd actually done our investigation within 5 days. So our client hadn't been notified. They would have to be notified in that case. Usually they should be notified of any mechanics lien filed against the property, but what had happened is that the actual office address that was listed for the client was the property management company. So they were assigned to deal with that, so they got all the mail. Well, when it turns into a bigger issue like a foreclosure, you're supposed to be notified. So we were able to detect that, and before they were ever notified, we were able to say, hey, we saw this. Do you know about this? Is this something you're aware of? Because no one wants their property to get foreclosed on something ridiculous. I think it was something like roofing. It was a pretty big expense. It was over 100K, but it's still like no one wants their $1 million apartment complex to be foreclosed on because someone didn't pay the roofer.
Absolutely. Absolutely. Okay. So this isn't one of the listed questions, but I did want to ask you because you brought up a lot of really good points. Say you're getting into an investment, no matter what side you're on. Well, let's stick with the syndication side. If you're an investor or the syndicator, what would be your advice as far as the major areas that you would want someone to come to you and get investigated, if that makes sense?
So I'm actually going to expand that question a little bit on the front end. So before you
Please.
ever come to me, I absolutely want people to kind of vet within their own networks and do their own underwriting first. So if you don't know how to underwrite deals, I would definitely get into one of the people that there's a couple of them that I can recommend if anyone wants to reach out to me. But you want to be able to underwrite the deal first of all. You can find so many issues that before you ever need to come to someone like me and spend money. You want to vet the deal within your network, talk about everything. This is a very early stage. Don't ever just do this, but when you're just deciding, hey, maybe I can invest in this and then I can do the deeper due diligence if I find good things, vet within your network, talk to people you know, talk to people that have invested with you guys in the past, make sure that everything's above board before you even consider doing the formal due diligence process. Do your napkin underwriting, do your network due diligence, and then move on to the other stuff. That's going to be more intense. That's going to take more of your time. And that's when you would actually call someone like me, say, hey, let's go ahead and start running a check. And that's the big thing I want to emphasize is that this type of check should basically always be run in some kind of way. Even if you try to do it a little bit yourself, honestly, there's some cases where I basically say never try to do this yourself because it's a very, very skill intensive task and it takes forever sometimes. So if there's issues, it's very possible you could spend, oh, I don't know, last week, actually this week, I have an active case right now that's taking forever because of just how much is involved in it. And just to get into a little bit is this guy seems like he's trying to hide a bunch of LLCs that are linked to him under different names, which of course makes it really, really difficult to see what actual lawsuits and judgments against him. So essentially how we usually work cases is we go front to back. We go, okay, we're gonna gather all the information on these people. Then we're going to go to the county courts and make sure there's nothing in the county courts. Then we're going to the federal courts. Well, I've been stuck at the county courts for about 3 days, and here's why. Every so often I'll throw his name into a different county, and then another business pops up that's linked to him. So that means I'm going back to every other county and rerunning every search to make sure that he doesn't have any other lawsuits under these other businesses, because that could be very, very dangerous for my client if he's got all these judgments and liens on him and they're constantly expanding. Eventually will run out of stuff to search, but it does take a while sometimes. But no, it's definitely something you want to do all the time. It's not a do it because you think there's a problem. Do it before you think there's a problem, because it's going to detect that problem for you. It's going to let you make informed decisions. And I know that's not practical for every investor. If you're just investing 10K in a deal here or there, honestly, just contact me. Don't wait about it. If you say, "Hey, I'm just investing 10K in a deal," all I'm going to do is give you advice and make sure that if a check does need to be run, like you bring up some really big red flags, that I find some way to do it for you. Because I do have to charge for my service no matter what, it's a business. But I can definitely work with the price if it's something that I'm like, hey, no, I don't want you investing in this. If you're still interested in it after we've discussed these issues, let's do some kind of discount. Let's run a report and make sure that you're investing safely.
Absolutely. Okay, that's awesome. Now, one of the last questions I want to ask you, because you did say that sometimes they take forever. I'm not very familiar with what you do, especially going that in depth. More than just our own personal due diligence on partnerships, whether it be sellers, whatever the case may be. What is your normal time frame, and what do you consider as far, something that's taking longer than usual?
Our actual turnaround time is usually 5 to 10 business days. That doesn't mean we're working on it every single day. We do get a lot of cases in, so sometimes some of them get spaced out so that they're still within that 5 to 10 days. Typically, what we see is complex cases can take 4 to 5 days, which means that's all we've been working for 4 to 5 days, and less complex cases maybe 1 to 2. 3 is kind of a sweet spot. Usually I can get them done between those regardless. If they're not complex cases, those are really easy to work. So I get those done within 1 to 2. If there is something really crazy going on, I try to get it done within the 3. But like I said, sometimes like the one I'm working on today, there's just too much here. There's no way for me to do it. So it's going to probably go into a 4 or 5 day case where I've literally been working on just this case for that time frame. And that's where that 5 to 10 business days actually comes in. And we're trying to space out everything so everyone gets what they need on time.
Okay, awesome. When you said it's taking forever, that was not the number or time frame that I had in mind. So that's good clarity. And that provides a lot of help, because I know there are investors like myself that are investing in new areas that we don't live in, don't have a lot of maybe boots on the ground, and we're trying to form relationships to help with certain aspects. So a lot of the answers that you gave covered a broad range of questions that I wanted to go over, and you hit all of them anyway, because what you do covers all of those bases across the board anyway. So that was really good. A lot of good information on how people can cover their butt. Now, one of the last things I want to ask you, when new investors are going into these relationships, and you already pointed out how and when they should do what they should do, how can people get a hold of you, specifically follow what you do, whether it be in social, you directly, to say, hey, I'm at the point where I need these services. How can I get a hold of Shane?
The best way to get in touch with me is probably LinkedIn. I get a notification on my phone right away, and my email's right on my LinkedIn page. So if it's something you're not comfortable sending over a LinkedIn message, you can send it directly to me. We can set up some time to talk about it. But I really like getting in touch with people through LinkedIn, just because that's where I get to post most of my content. I'm always posting about different issues in space, fraud, and even just some kind of motivational stuff. Every Friday, I do a kind of silly post about, well, it's not really serious. They're kind of It's not really silly. It's kind of serious. But I'm a history buff, so every Friday I post a kind of a lessons from the past type thing where I just go through a history lesson or whatever. So I really like being on LinkedIn. It's a great platform for me to do what I do. Make sure that people can get connected with me. They can see what I'm doing, and maybe they can protect themselves before they even need to call me.
That's awesome, Shane. That's exactly the kind of way someone should follow you, because I hope listening to this, more people like myself understand there are better ways to protect yourself, and ways you should protect yourself that they may not have been aware of before. If they at least start with following you, they can see the content that you put out and open their eyes. Oh, I never thought about that. So I think that would be a great way for people to connect with them. And we'll make sure you have all that information to connect with Shane. And I definitely want to thank you for your time today, Shane. It was an eye opener for me. It was probably a more personal conversation for myself, but which I didn't have a lot of input, because again, I was just listening to you, finding out all of the ways that people can protect themselves. So I really appreciate that. And I just want to thank you again for your time.
Thank you so much for having me on. I
Absolutely.
absolutely love going on calls like this and talking to people, just because you learn so much.
Absolutely. And that's what the whole point of the podcast is to learn from professionals, because you don't know what you don't know. And as soon as you hear a professional speak about it, it's like, that makes sense. Didn't think about that, but it definitely makes sense. So I definitely want to thank you. I want to thank everyone for listening. And remember, with a game plan and consistency, you too can expect success. Thank you so much.